Welcome to Grant's Interest Rate Observer of the Air. I am Jim Grant, and with me, as always, is the great Deputy Editor of Grant's, Evan Lorenz, and a new wrinkle to the new year, Harrison Waddell, the man of all trades at Grant's, is the sound engineer. And our guest today is the versatile Christopher Whalen, Richard Christopher Whalen. And we'll get around to talking to Mr. Whalen in just a moment. Evan, Happy New Year.
Happy New Year.
Yeah, we were up late last night. We closed an issue of Grants, and it was great. First one of the year. And what was your favorite part of Grants?
I think it was about 10:01 when we finally closed the issue.
No, I'm not asking you what time you got to go home. I'm asking you what essay was the best part of it. And let me give you a little hint.
The front page that you wrote was fantastic.
Thank you. See?
Questions the nature of money and kind of the risk that people are taking.
We're talking about fintechs and likening some of this to the single best quotation, Chris, that Christopher is among other things, is an acute observer of the present, but no less an historian of financial past. And Chris, I'm going to share with you by way of introduction, the single best, most colorful, and most perhaps informative single quotation I've come across about financial history and the nature of money and nature of credit and of banking. Right? It's a big claim. This comes from the Salmon P. Chase papers. He, as you know, Mr. Chase was a Supreme Court justice who had the pleasure of, did he reject his own? No, anyway, he had a mixed career. He was Secretary of the Treasury under Lincoln, and he said, and he was in correspondence with all sorts of interesting people, among whom was Joseph Medill. Medill was a newspaper publisher of some substantial means, and also a one-time perhaps two-time mayor of Chicago. Anyway, Medill was talking, this is May 30th, 1862. And nobody is allowed to turn this podcast off just because they think it's irrelevant. This is totally relevant to everything we're going to talk about. And Medill was reporting to Chase, to Salmon Chase, about the state of things in Chicago and about the state of credit. And he said, he said we need more Treasury issues. In the place of those is now filled up by, quote, the irredeemable trash of 1,000 shin plaster debt factories. It's not that marvelous.
Yes, it is.
Yeah.
Especially given his role in financing the war and the railroads and everything else. So.
Well, Chris Whalen, as you've perhaps have picked up from that knowing laugh, is an historian who has written a new book. We'll hear about that. He calls himself an investment banker first and an author second. In a subsequent edition of your CV, Chris, might you consider reversing those just for the sake of the dignity of the individual?
Sure.
Yeah, okay. Just think about it. He's the chairman of Whalen Global Advisors. Chris speaks with the authority of a practitioner in finance. And indeed, he has been a professional ratings agency chieftain, head of research at Kroll Bond Rating Agency. He has done things in mortgage finance, fintech, banking. He was the first journalist to report on the then secret FOMC minutes concealed by Fed Chairman Alan Greenspan. This is 1993. And that's why he's here today. He's here today for all the above. Anyway, I'm not going to go on, because as he speaks, you will gather from the knowledge and authority that he brings to this table what he is all about, and the formidable powers that he brings to any financial analysis or discussion.
Thank you, Jim.
Yeah, good to have you here. So where to begin? I mean, Christopher, among other things, you are the bank analyst, non-pariah. And the banks are giving voice today to their latest results and covering up some of them, I suppose. And we may begin by asking, what do you think of the state of banking equities, large bank equities now? Overvalued, undervalued, overvalued a lot, a little, credit quality good, fading, good, strengthening. What's the story?
I think at the present time they're a bit overvalued compared to their earnings potential and revenue growth potential. You know, last August, September, we were talking about a recession. Didn't happen. The banks then went on a tear.
Yeah.
They were up 45%. We publish an index on banks now, amongst my other activities. And the fascinating thing is that the better performers, Synchrony, Ameriprise, American Express, were up 60, 70%. And this all continued
Do they
to...
make computer chips on the side?
You would think so. But no, it was just that managers rushed back in. They decided they needed to increase their allocation
Exposure,
to banks.
yes.
That's right. And so by the end of November, though, after the election, all of this slowed down and they started going back down, except for Fannie Mae and Freddie Mac, which were by far and away the best performing financial stocks in 2024 and also 2023.
And 2025.
Well, yes, they're continuing. The hedge funds and other touts that want to see them released have been doing a classic pump and dump, as we say on Wall Street. And as I told my readers, I say, remember, this is a trade. There is no destination here, because if we actually release them as they are, I give them very, very small chances of survival.
Would this be like a little girl releasing her pet hamster into the wilderness?
No, we're releasing the hamster out onto Broadway in Lower Manhattan.
No, what would cause the reappraisal, the revaluing of these things if indeed they got their freedom, walking papers from the government?
Well, in the past, Jim, as you know very well, we pretended that they were part of the government, even after Lyndon Johnson pretended to privatize them. And we went on like this. I had to observe this when I was at Kroll Bond Ratings. I have the letter from S&P that describes the special relationship between the government and the GSEs. But now, in 2024, we can't pretend anymore. A lot of things have changed. As Ed Kane used to remind me over and over again, we can't go back. The rules of history apply. So essentially, if they were released tomorrow, the $8 trillion worth of debt, both residential and multifamily, would be downgraded to follow whatever rating Moody's and S&P gave to the issuer. And more importantly, they would really be private. So they would have to function with maybe a AA or a single A plus rating. Their debt costs would go up, and they would be a private guarantor now. They would not be the federal government guaranteeing those securities. Initially, I thought we could cut a deal and maybe pay Uncle Sam 15 or 20 basis points a year to cover the bonds and then leave them private. But that doesn't work. Because if we get them out of the guarantee business, what's left?
What would that do to the cost of like the average 30-year mortgage?
Go up anywhere from half a point to a point. But more importantly, the conventional market would shrink. The banks would come in from the top. They love those big loans with high FICO borrowers attached to them. And then in the bottom, the FHA and Ginnie Mae would start to eat away at those smaller mortgages because they are much more competitive. Imagine if the GSEs had to raise their fees to survive. They charge 60 basis points today, more or less. Imagine if it went up to 80 or 90. The private market would come back. There's enough juice in that trade then for the banks and also private investors to expand. So it would change the topography of mortgages very significantly.
What is the state, the credit state of mortgages and the books of Fannie and Freddie now?
Oh, pristine.
Yeah.
You know, if you go from bottom to top, the FHA delinquency rate's about 11%. It tends to correlate with the FICO score of the borrower. FHA is a good indicator. I would tell you it's understated by about a third because forbearance and modification are now mainstream tools. The bank paper, on the other hand, Jim, at the top of the stack is got a negative default rate. You almost can't lose money lending on a residential home. And the conventionals in the middle, about half of the market total, are fine. The default rates are around 2%, thereabouts.
And taking a step back to Jim's original question, what is the health of kind of, I guess, the big banks, taking aside Fannie and Freddie for a second? Because on the one hand, we now have a positively sloped yield curve again, and when you borrow short and lend long, that's good. Trump is coming along, which should mean at least some regulatory relief or at least less new regulations going forward. Yeah. At the same time, we're seeing credit costs normalize, which is slowly increasing. They're not an alarming level. So when you take everything together, kind of what's your outlook for bank and bank earnings?
Well, as we saw this quarter, the transactional side of the house, which lives on volatility, is done well. Goldman, JP, all had very nice numbers in terms of underwriting both debt and equity. So the markets came back, especially debt. The bank side, however, is different, which is that loan growth has been relatively slow. J.P. Morgan only put on 1% loan growth last year. And, we have repriced the loans, thankfully. The average spread on those loans is up in the 6s now, which is good. It was down in the 2s during COVID. The trouble is, on the securities side of the house, you still have a lot of banks that are sitting there with production that was made in 2020 and 21 that has coupons in the 2s and the 3s, the stuff that the Fed owns, basically. And it's just a dead weight around their neck. So you have Bank of America, Truist, PNC, all of whom have appalling average yields on their securities book. Schwab is another one. I just wonder, are they paying attention? Do they care? I mean, these people get paid to do this, right? Because then I compare them to American Express or some of the other smaller, very well-managed banks, and they're fine. In fact, American Express doesn't own any mortgage-backed securities. So they have treasuries, they have some other things, but they manage that treasury book very small, and they keep it really with a current coupon.
Yeah.
It's almost like the broker-dealers. The broker-dealers don't keep big portfolios. So all of the stuff they own today is pretty much current production from today. You don't have a lot of mark-to-market risk.
Let's talk about the biggest bank of them all, the Federal Reserve System. And Evan and I are going to. This comes free of charge with the rest of this podcast. We're going to give you, ladies and gentlemen, a little tutorial in marking the Fed's net worth to market. You ready? So every Thursday at 4:30 or so, the Fed publishes something called the H41 form, and this is a lot of verbiage that basically means balance sheet. So don't you want to know what the Fed's Evan, would you want to know if the Fed's capital is adequate to support
You mean
a
if it's
balance
broke?
sheet? Yes, $6 trillion balance sheet. They must have a lot of capital, right?
They do, but they also have a lot of losses. So every week, the Fed publishes the H41. It's a 12-page document if you print it out double-sided. If you want to know how much capital they have, it's actually relatively easy to find. I'm right now at table 5. Their total capital is $44.1 billion.
Okay, that's the capital. Now, as you know, as Chris just intimated, the Fed just went crazy in 2020, 21, 22, buying things it ought not to have bought if it were a profit-making organization, which assuredly it is not. Okay, but the Fed goes to some lengths in a form of accounting that one might call DIY. I think this accounting is nowhere else practiced. But if you go to Table 6 of the H41 form, and this is, ladies and gentlemen, this is available to every citizen in America, so please do this with us. Go to Table 6. It's called Statement of Condition of each Federal Reserve Bank, January 8th, 2025. Okay, so you want to look at earnings remittances due to the U.S. Treasury. You there, Evan?
Yeah.
What do you see?
Negative $217.5 billion.
Oh, it's just a footnote to explain. So go to footnote 8, and would you give us a dramatic reading of this?
The Federal Reserve Banks remit residual net earnings to the U.S. Treasury after providing for the cost of operations, payment of dividends, and the amount necessary to maintain each Federal Reserve Bank's allotted.
Come on, get to the point.
Essentially, as Chris pointed out, they sit on a big bond portfolio that has a 2 to 3% yield, and to control interest rates, they pay interest on around 4.25% on excess reserves and on reverse repo, and that negative 2-point spread has basically been costing them $200 billion over the last 2.5 years.
That's no way to get rich, Evan.
It's a bank error in your favor.
Okay, so that's the fact that the Fed is on an ocular basis, as it were, broke. It does get a free line of credit from the Treasury, no due date and no interest payable, but as a matter of fact, it is, as it were, insolvent. So, not as a fact. That was a fact? Or is it the formulation of someone who's not buying into footnote 8? It's a philosophical question, isn't it?
It is, yes.
Oh, okay. Christopher, as you know full well, the Fed is in one sense an entirely government-owned operation, and yet 100% of the dozen Federal Reserve banks is owned not by the taxpayers, but by the member banks. And the member banks earn, or at least are paid dividends. Now, on the stock. So, Evan, if you were keeping score at the Fed, or Christopher, if you were keeping score, would you continue paying dividends to these banks
No.
once you got to be broke?
And I wouldn't pay the Consumer Financial Protection Bureau either.
Right. However, I think Alex Pollock, who was a wonderful student of these things, for this, that in the first 9 months of 2024, the Fed paid in the aggregate $1.2 billion in dividends to their shareholders. And does that seem like a misappropriation of something or other?
Well, it is. I mean, Congress deliberately created this legerdemain where we have capital. The cap is 40-something billion dollars. Remember, they confiscated the rest.
Right, for highway projects.
For highway projects. But the account that Evan was just referring to is kind of a contra account off to the side where the Fed gets to earn their way out of the losses on the hedge fund. And, further to your description, what I would say is not only is the Fed broke, not only have they, made a horrible investment decision, but they appropriated or misappropriated funds from the Treasury. These are funds that come from Treasury securities that belong to the United States. And they then went out and lost money on it. So not only does the Treasury not get the benefit of the savings when they monetize debt on their portfolio, but they use this funding to engage in fiscal activity, things that a Jesse Jones would have done during the 1930s. And again, without bothering to go to Congress, because the Fed assumes that nobody on Capitol Hill can understand what they want to do.
Well, that's a good assumption.
It is, but what gives them the right to proceed anyway?
Yeah, and on top of all this, again, to allude to Alex Pollock's point, they're paying out dividends to private institutions with money that doesn't exist except on their phony accounting.
Well, the Treasury is the alter ego of the Fed. They're alter egos. Well, an asset for one is a liability for the other.
Could you speak to the independence of the Fed in this context?
Well, there is no independence. The peak of independence was 1951, and it's been downhill since then. When the Treasury deficits got so large, and also I think when the dysfunction in the primary dealer market grew so concerning, they essentially had to come in and buy it. That's what happened in 2020. And that gives you a sense of what will happen in the future. That was the roadmap. So in 2028, we annihilate a third of all primary dealers. They just went bye-bye. And in 2020, when we had the COVID scare, they literally had to come in and buy an auction. Now, they told everybody they were stimulating the economy, doing this and that, but in fact, nobody was going to buy Treasury bonds. So the Fed came in and bought them through the dealers. When they do this, deposits go up, reserves go up. And this is the real, I think, terrible error of Ben Bernanke, thinking that you could, let the genie out of the bottle and not have politics come into play and turn this into a fiasco for the central bank. If they had just, Jim, bought the securities and not reinvested, that would have reduced the losses by half. But they didn't do that. Janet Yellen and the rest of them said, we have to stimulate the economy. So they started messing around with long-term yields on treasury bonds. Remember Operation Twist? Just keeping the portfolio at this size was meant to be a palliative.
And buying a lot of mortgages.
Oh, well, buying the mortgages was a disaster. They should never have done that.
In your forthcoming book, Inflated Money, Debt, and the American Dream, which the second edition is going to be published in May, you highlight the fact that since 2008, the primary dealer market has been hollowed out. The Treasury financing market has been increasingly fragile. It essentially broke down in September of 2019 when the repo market seized up.
Yes.
And the Fed basically had to step in March of 2020 when the Treasury needed to issue a lot of debt to fund an economy that it had shut down. The Fed was able to do that by basically printing trillions of dollars, which ultimately led to inflation. Right now, we're in a moment where deficits are still high. They're around 6% of GDP, which is a level you'd normally see in wartime. Debt is over 100% of GDP, and we're still at a point where there isn't a very well-functioning primary dealer market.
No, it's a bank market. It's right back to where we were at the end of World War II. Because people forget, Josh Menand and his colleague, I can't remember his first name, Younger, did a brilliant paper for Columbia Law School that talks about the legal history of the U.S. Treasury market. And people think, well, there was always a Treasury market. No. The market was created by very smart people in the U.S. government. And after World War II, they wanted to separate the Fed and the issuance of treasury securities and create a little bit of breathing room for the central bank, because they had been buying all the treasuries throughout the entire war, and they kept the interest rates fixed at the behest of the Treasury to help with the war effort. After that, however, they, in a marvelous and very ingenious fashion, created a whole new group of non-bank financial companies that could finance treasuries with repo. And an overnight repurchase agreement is almost better than a bank deposit, or at least it used to be. So, when we ignore that history and then come forward to today and look at how things are being financed today, I think you've got to be very concerned about how we are going to find our way through, especially if our new president decides he wants to cut taxes again.
But what happens during the next Treasury market season? Because the Fed in 2020 was able to patch it over by just printing a lot of money. But now we've learned that printing too much money can lead to bad consequences.
Well, it wasn't printing money. They were buying securities from banks, and they were taking those proceeds, which essentially belonged to the United States, and depositing them in bank accounts at the Federal Reserve. So reserves grew and deposits grew. Now, it wasn't the kind of deposits you could use to make a mortgage loan or a corporate loan, right? But the system grew. Go back and look from 2008 to today at how fast the banking industry has grown. Does that say we have low inflation? No, that's the problem. And the Fed misappropriated funds and used them for this, Zytec that Ben Bernanke created after imitating the Bank of Japan. The Japanese never would have done anything this silly. But
yeah, they would.
Well, if pressed, I suppose they would. But
they have.
Yeah. Well, it hasn't worked very well, has it?
No.
And I think I added a whole chapter to the book just for Janet Yellen and Chairman Powell.
Did you run it by them?
No. I didn't do that with the Ford book. I don't do authorized books.
So your latest book basically looks over U.S. economic history, what the dollar has meant over time, what the nature of money is, the way the financial system is set up, and you do a great job of explaining it in layman's terms and putting it in things that are relatable, like relating bimetallism in the late 19th century to cryptocurrencies, which I thought was...
Isn't it delicious?
Which is funny.
The same, except at least silver added something to the national wealth.
Yes, but the brilliant period before 1900 when the Treasury was buying silver with fiat, and then people would take the paper and go redeem it for gold.
Yeah.
What a circus.
The endless circle.
But this is a democracy, right?
Mm-hmm. But taking your book the other way around, so looking back over the last 2 centuries of history, how does the current moment, I guess, are there any parallels to it? Because we are at a place where speculation's high, asset prices are high, deficits are high, debt is high, and it seems like people don't really care about, I guess, fiscal probity.
No, it's like we're right back to kind of the mid or early 1800s when right before Salmon Chase.
When I was born, is that what you're trying to say?
That's right.
Yeah.
Except everything is reversed. Instead of insecurity about money, we have an excess of things that are supposed to be money, but we're not sure if it still has value. This is why people are so easily able to create new games, as I call it. That's what crypto is. It's party poker on LSD. So, essentially we say to ourselves, well, I can't make a living doing what I'm doing, so I'm going to create a new game. And that's what crypto is. Americans are ingenious in this sense. We were issuing, how many different types? I think we had 6 kinds of dollars in 1900 before the creation of the Federal Reserve System. So we're kind of going backwards. It's like somebody stopped time and twisted the dial, and we're going back in time. In a very strange way, I must say.
But not back to the rigors of double liability for
No.
bank shareholders,
No.
or balanced budgets, or redeemable currency. Right?
I don't think people know what money is anymore. They haven't had to worry about it.
What's money?
Exactly. Well, gold is money. It's the only money that's not debt.
Have you seen this book by Dan Auray called Beyond Banks?
No.
He's a Cornell professor, very learned, and especially about the intricacies of bankruptcy and about the distinction between FDIC resolution protocols on the one hand and corporate bankruptcy on the other. And he invites the holders of cash balances on various DeFi or fintech payments platforms to consider what it would be like to undergo a corporate bankruptcy rather than one of these nifty 24-hour resolutions of the FDIC. There's a whole lot of money that thinks it's insured through kind of pass-through, whatever, and is actually not. And
Well, FDIC was trying to deal with that. They had a rule last year dealing with brokered deposits, and when you have fintech companies that are acting as intermediaries for deposits, because they aren't deposits. I remember when Sheila Bair was chairman of the FDIC, she had a situation in Maryland where they were taking quote-unquote deposits, but they really weren't. And she brought the FBI along when they closed the bank because it was appropriate. It was fraud. And you see this periodically. People are always trying to scam the banking system.
It's the fraud is sometimes calculated.
Yeah.
And artful and criminal, but other times it's the kind of fraud that the victim brings on himself or herself by not reading what is meant to be read, right? So if you go on PayPal or many of the other larger platforms, they'll tell you exactly what is in store for you in a corporate bankruptcy.
Mm-hmm.
That you are a claimant on the estate and not necessarily first in line, right? They'll say that, but how many people know that?
Well, that's right. PayPal's not a bank.
No.
They have toyed with bank licenses in the past, but it's just...
They have $40 billion of customer deposits.
That's how I send Mom cash every month.
How long does your money stay on the platform?
Oh, moments.
30 seconds.
Yeah. I don't keep deposits there now. Thank you. There are people that do. Now, I have transaction accounts at PayPal that I clean out periodically because it'll sit there unless you go get it.
Well, yeah, it's like a subscription to Paramount.
Exactly.
Why do they do that? Right?
Well, or airline miles, right? All these things that we think have value.
That's money.
It is money. That's right. You can sell it.
It's not just money, it's status.
It is status. That's right. But humans are funny that way. I think they almost value status and novelty more than they value security because they haven't had to worry about security, to your point.
Correct. The issue of grants that Evan was kind enough to compliment just out today. We say that the culmination of this aging credit cycle will have an exclamation point attached to it, bang, by happenings in the fintech world.
Yes, I think that's right. And also commercial real estate. We're not nearly done with that. And I think also just general corporate defaults this year and next year are going to get rather toppy. Won't be consumer yet. You got to wait for that. A couple more years.
Can I ask about kind of the rising tide that's lifted all boats? In your book, you make the point that when the Fed went off and printed so much, or not created so much new reserves during the post-COVID era, that excess liquidity showed up in the RRP, the reverse repo facility.
Yes.
At one point held over $2 trillion. Today it's been whittled down to, I think, $160 billion. Is the financial system, we've been riding high in this liquidity wave since then. Is liquidity drying up, and will that become a problem in the next year or two?
Yes is the answer, but we don't know. It's like we're in a dark room, and we're trying to reach down with our hand to find out where the floor is. Now, the Fed has this model that was developed by a friend of mine years ago that was really meant for intraday liquidity, but they use it for long-term liquidity, and they model it against GDP. So the truth is, as we saw in December 2018, 2019, they don't know. They are hoping that this massive surfeit of liquidity is going to solve all problems, as opposed to lifting all boats, right? But honestly, they don't know.
Well, yeah, I think they acknowledge that. Pretty much, they don't know. So this is the only price discovery they seem to be willing to undertake.
Well, what happened in 2018, I was sitting on a desk watching this, is that the big banks had plenty of liquidity, but Jamie was happy. Jamie didn't need to touch his numbers anymore. This was very early part of December. And he said, well, we're not going to lend any more money. So when the biggest provider of cash to the repo market says he's had enough for the year and he closes his books, all of the little firms were screwed. And we weren't able to go to the Fed at this point. Since then, the Fed has said, okay, we'll lend to everybody. They have the standing repo facility, right? But none of this is really effective because in the process of developing all these solutions, they killed the market. They nationalized the Fed funds market. It doesn't exist anymore. The dealers don't exist anymore. So what we have is the government trading with itself. You have this government entity called the U.S. Treasury, and you have this other government entity called the Federal Reserve, and they are mirror images of one another.
But isn't it a little bit like kabuki theater, because the Fed cannot buy primary issuance from the Treasury? It has to buy secondary issuance, which means that the dealers get their markup, even if they're, hollowed
The
out.
boys at Goldman have to make a living somehow. They lose money on many other things, so, got to leave a few crumbs on the table. But yes, they have to go through dealers because the ancient probity of the people who designed the Federal Reserve Act said, well, the Fed and the Treasury can't face one another directly. Today, such niceties are probably no longer meaningful, but that was how Carter Glass and Harry Stegall and all the framers of the Federal Reserve Act felt. They wanted to isolate them. They didn't want the Fed buying Treasury bonds. The Fed couldn't even buy Treasury bonds at inception.
So Fed did not have Treasury bonds on its balance sheet throughout the 20s. It was a classical central banking balance sheet with gold, principally, then commercial bills.
Yeah, it was real bills. That's right. Imagine if we tried to do that today. We don't even have real bills.
Real mortgages.
Oh, no.
It's slightly different
But imagine,
from a liquidity point of view.
are these learned PhDs at the Fed buying a variable duration security and not understanding what they were doing? As I'll tell you a funny point nobody really understands. After the great Powell near miss in December 2018, what did they start doing? And this is a year before COVID, okay? They started selling TBAs in the mortgage market. These are forward mortgage contracts.
Yeah, you have to explain some of this. TBA.
When you get a mortgage, your mortgage bank sells that loan forward, 30 days usually. Sometimes they'll go out 60. And it's a way that they hedge interest rates. This is also, by the way, how we hedge interest rates in the Treasury market. Very important. It's the second largest market in the world after Treasuries. So the Fed started pushing interest rates down in early 2019. They had pivoted completely. And I saw this because the duration of the entire Ginnie Mae book, which I follow very closely, started to fall. It started at a 5, and then it got down to about 3. And when COVID exploded in the first quarter of 2020, that went down to 1. Now, this was the point where Silicon Valley Bank was busily rolling over their portfolio every quarter and buying more. The existing mortgage backs that they had with 5 and 6% coupons had prepaid. So they went out and bought some 1s and 2s. And when rates eventually rose, they were insolvent. They were wiped out.
So while Silicon Valley Bank was loading up on duration at the single worst time in U.S. history when rates hit their all-time low,
Yes.
I remember, I think it was either third or fourth quarter of that year, an analyst asked Jamie Dimon at the JP Morgan conference call, Jamie, when are you going to take up duration in order to protect net interest income? And Jamie said, that doesn't protect net interest income. Next question, please.
Right.
What is the mistake that people in the financial system are putting on today that will look like that decision Jamie Dimon made 3 or 4 years ago? That in retrospect, everybody will realize that was a huge mistake.
I would say Jamie did better than most. He kept his duration neutral. It wasn't great. It wasn't like the way American Express manages their book, but it wasn't nearly as bad as Bank America. So, for example, Bank America was writing 1.5% and 2% mortgages in 2021. What was the proper trade? Sell the mortgage into a mortgage-backed security, take 2 points out, gain on sale. Because remember, everybody in the mortgage market was making tons of money at that point. Like, you could almost not help make money at that time. And then buy T-bills. That was the trade. So they should have been selling the long-duration mortgages, make a lot of money, put that money in the T-bills and wait. Don't listen to the Fed economists talking about the transitory nature of inflation. But unfortunately, very few banks took that advice. And I would say a third of all U.S. banks today, going back to your question about the industry, have this stone around their neck in terms of their securities book. And they don't dare sell it because they would take big losses. So they're just going to sit and wait, and it will affect their earnings for years and years to come. Jerome Powell will be long gone, if not up in the pearly the gates, by the time that portfolio at the Fed starts to move. The prepayments on their mortgage book now are probably around 4 or 5% a year, which is extraordinary. In most prepayment models, we assume 6 is the lowest number you can have. But the actual experience on some of those low coupon portfolios is even lower than that.
Okay,
So they're waiting for people to die, in effect.
Yeah. Well, for one, I'm not going to oblige them. So I promise. So, Chris, we've been sitting around here like a an old guys club agreeing with each other on all of the stupid mistakes other people have made. And let me ask you, if you were in a position of, let's say, not investment banker nor author, your principal works in life, what would you, say you were an emperor, how would you organize or reorganize American finance and public finance? What would you do to restore balance, solvency, and and prudence to the system?
Well, I think first and foremost, you have to interpose some sort of controller function between Congress and expenditure. As Hayek said, it's impossible for a democracy to have good money, and in large part because of fiscal spending. When you have a blank check that the world has given us since World War II, we are the reserve currency. Well, we can borrow as much money as we want until we can't. That's it. So that would be the first point of attack. I think also we need to reacquaint Americans with the notion of inflation and money. How do you do that? I would have Treasury not only start to buy gold again for our portfolio, but I would like to see us issue gold coins, not by monetary value, but by weight. And I'd like to see Treasury publish a price every day where they will buy and sell gold. That would be the best indication of seriousness on our part, that we are going to honor our obligations. But it would also give Americans a way of hedging their own personal portfolio, and every day they would be able to see what was going on with prices. And you could give them a yardstick to understand this. Because, other than the last couple of years when people have really been impacted by price increases, did they think about inflation? No, the inflation was their friend. They assumed their house would go up in value every year. We assumed commercial real estate would go up in value every year, right? Here's the key question I've asked a couple of times. Could the commercial real estate market in the United States survive without inflation? I mean, for the last 50 years, you had people taking money out of commercial properties when they refinanced. It was a profit center for them. Not anymore. It's a sea change that we've seen in commercial property. So that's where I would start, Jim. I think we have to short circuit moneyness and reacquaint people with value again.
What would you say to holding the Fed to GAAP accounting standards?
Oh, well, that's government accounting. It's not just the Fed.
No, GAAP at the Fed.
I would applaud it. I think that the audit the Fed movement really missed the point. It's not whether or not they can add and subtract. We know they can do that. The problem is what they do with that skill set.
They can certainly multiply.
Yes. So, yeah, I would hold them under GAAP. I mean, you'd have accrual accounting. That would be interesting with the Fed. But I think you would have to hold them much more accountable for what they do with open market operations. Open market operations were supposed to be incidental. They were never meant to be primary. And yet here they are, and that's a function of debt. When the Treasury gets too indebted, the central bank has to become more and more actively involved.
The Fed began as a classical central bank along the lines of the Bank of England during its heyday, and it would lend passively against good banking collateral to banks that applied for the privilege against mostly solid collateral. And in the mid-'20s, when the banks thought they needed some more income, they instituted open market operations to earn a little side hustle. And then the rest of it. Then came the New Deal and the socialization of so much risk, and the mobilization of the Fed for means other than those anticipated by the founders, right? And so it seems to me that if I'm reading your latest book correctly, that we have seen a secular or Kondratiev-style major wave in the socialization of risk.
Oh, very much. But, it's funny, during the Depression in the 30s, the Fed was involved very much, but they wouldn't do many things. So they created new GSEs, like the Fannie Mae, which was basically a thrift, a big balance sheet for banks to sell mortgages to.
Home loan bank board.
Right. So there were many things that they wanted the Fed to do. The Fed said no. But the architectural role that they played in the New Deal, the seizure of gold, all of these other bad acts that they engaged in, I think it was very telling. As you and I both know, there are no conservatives who are allowed to work at the central bank. It is a progressive socialist institution from day one. And unfortunately, if you don't control it and constrain it, it will grow. I think in many ways we have to remake it entirely. I would like to get the board out of Washington. I'd like to add 3 more reserve banks out west. We clearly need them. We'll turn branches into reserve banks, right? And just get the whole game out of the city.
How about a headquarters in Akron?
Akron, perfect. Or Cleveland, beautiful city. You know, the cities on the lakes don't really have a purpose anymore.
Watertown.
Watertown, yes. That's
Lake
right.
effect snow is lovely.
Exactly. They would be snowed in. Perfect.
Or maybe snowed out, perhaps.
Yeah. But yeah, I think that's unfortunately, when we crash and burn, and we will, that's the kind of change we're going to have to see.
Okay, does the date, August 1st, 1973, resonate with you?
No, tell me. What am I forgetting?
That was the date of the failure, explicit failure of a 20-year bond auction.
They don't like those 20s, do
No.
they?
It's the red-headed stepchild of the yield curve.
It really is.
So the question leads to another, which is, in your opinion, is the problem with the Fed and the Treasury that the architecture of remediation, that is to say, the primary dealers and the lack of capitalization in those firms that are meant to buy and distribute the bonds, is that the problem, or is it the fundamental problem of too many securities at the wrong price?
I would say the latter, too many securities at the wrong price. The dealers were wiped out by volatility that they couldn't anticipate or manage.
The average American interest rate, I want you to, would you call it 5? Or I'm talking about a composite investment grade interest rate from the founders until today, 5 or 6%?
Thereabouts, yes.
Yeah. So what would happen if 5 or 6% became today's rate across a range of securities? Could a leveraged economy handle that?
I think we're going to find out. I have been telling my clients, my mortgage lender clients, for a couple of years, I said, this is the floor, 4, maybe 5%. Get used to it. And all of them were betting on a rally. They were all betting that the Fed would cut rates back down to 2. So I totally agree with you, Jim. I think about Fed funds at 4 or so, maybe as the floor, and long bond goes to 6 or 7.
So another question for the financial historian to my left. Interest rates are unusual in that they trend over generation-like cycles, unlike most other financial prices. 30 years down after the resumption in the 19th century, resumption of gold payments, 20 years up from 1900, 1920, quarter of a century down until 1946, and 35 years rising rates till 81.
Mm-hmm.
And 40 years of decline until about 2021, at the culmination of which 18 trillion or so of securities are priced to yield less than nothing worldwide. So that's the preface to this question. Are people perhaps imprisoned by 2 generations worth of falling rates? That is to say, is their imagination constrained from conceiving of a secular bear market in bonds?
Oh, I think very definitely. And you see this in the pernicious effect of inflation on the bond market today. So what did we see over the last year? People going into the market, buying bonds, let's say almost delinquent bonds, to put into credit strategies. And this buying has compressed corporate bond spreads to the lowest levels we've seen in 15 years.
Evan remarked on this in the current issue of Grants.
But what is it telling us? It's not telling us anything, because bankruptcies are rising. The quality of issuers is awful, especially in private equity land. So you have this weird cross purposes of investors who aren't paying attention to the fundamentals at all. They're too busy putting together a retail strategy for credit. And this is literally distorted the market. I fully expect bonds to give up a lot of ground this year.
And just to cite the numbers we quoted in the most recent issue, if I remember correctly, U.S. corporate bankruptcies hit a 14-year high last year. They were the highest since 2010, whereas the high-yield bond spreads were, I think, 2.81%, which is roughly half of the 25-year average. So you're not being compensated much for rich. And those bankruptcies were actually understated, because for every 1 bankruptcy, there was about 2 out-of-court maneuvers to try to keep a levered company alive. These are liquidity management exercises.
That's right. And remember, forbearance and modification, those 2 key words, are now widespread. Not just consumers. Remember, we had COVID, we had moratoria. We also had moratoria for business loans. So what do banks do now? They don't want that property. They don't want that building on Broadway. They modify the loan, and they'll keep modifying the loan so long as they don't get the asset back.
And in private equity land, there's an investment advisory bank called Lincoln International, and each quarter they put together a summary of kind of just PE valuations and leverage. And in their most recent report, I think they said the fixed charge coverage ratio, which is how much a buyout covers their capex and interest with EBITDA, was essentially one across the entire universe. The entire universe of U.S. private equity, in aggregate, essentially just covers its fixed charges.
Private equity is a criminal activity of a scale we haven't seen for 100 years in this country. Remember all of the vehicles that were floated during the 20s?
Christopher, have you ever been accused of hyperbole?
No, listen, it's a self-serving conspiracy. These people have no interest in telling you the reality, and they're certainly not going to tell their clients. Look, as a member of FINRA, I am always mindful of the fact that I have a legal duty to point out wrongdoing. I'm a general securities principal. If I see you doing something wrong, I have to turn you in.
It must be hard to have friends on Wall Street.
Well, yeah, it's okay.
Well struck, Evan.
Well, the F word is always dangerous to use. You have to be careful. But look, I think fair dealing is one of the most fundamental principles that we have. It goes all the way back to the Greeks. If we don't treat one another fairly, then what are we talking about?
Profits.
Careful, Jim. You're going to have some young man in a hoodie following you home tonight.
Well, Christopher, this has been nothing short of delightful. I mean, what are you doing tomorrow? I'm not sure we've covered enough points on which we can absolutely agree. I think some of the audience members might have left us a while ago in disgust at the unanimity of sentiment, but we're telling the truth, are we not?
We are trying. I try and point my flock in the right direction the same way you do.
Well, Evan, have you?
I would like to end with just one small quote from your book, which I just love, kind of gets to the human nature and also American nature. Even if the United States were to return to the gold standard tomorrow, the wizards of Wall Street would find a way to create new vehicles for leverage and speculation, just as Gold, Fisk, and Cook did more than 2 centuries ago, which, again, I think gets to the nature of...
But think of the audacity of those men, that they perceived the arbitrage between metal and paper. And this is the same thing that Bagho wrote about years before, where he said, you have to have a high enough rate to coax that metal out of private hands so I can put it in my bank and lever it up. But to your earlier point, Jim, that book you referred to, do we need banks for leverage anymore? Not sure. Banks were a catalyst for leverage. That's what we did with them. Then we created national banks, and they had even more leverage. I think of the whole history of the United States as layers of leverage. It's like a big tiramisu.
So for your next book, I've got the title. Ready? Dollars to Donuts.
No, a good friend in Washington actually gave me an idea. I haven't had time to act on it. He said, Chris, you should do a housing book called Playing House about Washington and housing, which I think would be a lot of fun.
Yeah, nothing like having a friend tell you what book to write next.
I know. You and I have both had a lot of people suggesting things for us to write.
Christopher Whalen, central banker, author, investment banker, FINRA guy. Thank you for being with us.
My pleasure, Jim. Thank you.
Until next time, ladies and gentlemen, thank you for being with us on Grant's Interest Rate Observer of the Air, the current yield.